For this next video lecture, so this is still part of the performance evaluation of the investment center. So the second evaluation measure is the residual income. Okay, so RI or residual income is the difference between the operating income and the minimum dollar return required on a company's operating assets. So we have here the formula, okay, to determine the residual income. So your residual income, just like as what we have mentioned based on the definition written here. So that's operating income, okay, minus quantity of minimum rate of return times your operating assets. Okay, so basically, residual income will determine if the investment is effective, because here we can see that your operating income is greater, okay, than that of the minimum required rate, okay, from the operating assets. Okay, so to understand better, so we have this illustration. Okay, so we will use this illustration to explain further what residual or how to determine the residual income. Okay, so we have here the data also. Okay, so we will use the same data from this company. So we use also this data in determining our return on investment, okay, in our previous video lecture. Okay, so here, this is for the snack foods division and the appliance divisions. Okay, for the residual income, so using our formula. So this one, for number one, this is for the snack food divisions. Okay, so operating income is 1.8. Okay, and then we will use the 12% minimum rate of return required for the company, and we will multiply it with the average operating assets. Okay, and then we will deduct it from the operating income. So for the snack foods divisions, our residual income is $600,000. For the appliance division, so the same process, and we've taken also the data from the table right here. Okay, so its residual income is 1,170,000. Okay, so if we will compare these two divisions, we can say that appliance division is better because they have higher residual income. Okay, so what if the minimum rate of return is 16% instead of 12%? So what will happen? Okay, so in this case, for the snack food residual income, okay, it will be at 200,000, while for the appliance division, it will be $390,000. So if you could notice, the residual income decreased because the required minimum rate of return increased. Okay, and our operating income stays the same. Okay, so that's why the effect is it decreased, okay, their residual income for the both divisions. Okay, so that's for residual income. So this is how you use and determine, okay, for RI, especially in measuring the performance of an investment center.